If you want to invest your money in your name, don't give the money to other person or don't take money from other person for the investment purpose. If you're planning to invest 5 lakhs a year, so do one thing. 1 lakh invest in the long term and remaining 4 lakhs you invest in the short term. If the current assets are 2 rupees and current liabilities are 1 rupee, then it is a better decisions are taken by the organization. Warm welcome to 4th Sem B.Ba students. In our today's session, we are going to learn about financial savings and other sectors, how better it will be there for your future. I am Professor Rajesh L.R. from Department of Commerce and Management from Vidhyaashram First Grade College, Temple of Excellence, MYSURU. Today's agenda is which are the factors are that there which influences the investors and what will be the risk profile for the investment what we are making. What are the major investment objectives are there? What are the popular risk profiles are there in the investment criteria? What are financial securities? What are the different kinds of issues are there? And which are the key ratios are there which are used for the analysis of financial statements and to analyze the financial performance of the company. Every concept we are going to learn in easy manner. Factors that influence the investor's risk profile will be the major will be earning members. If I'm the only person earning, so then I have to think that one, whether let me invest my earnings in this particular investment or not. If I'm the sole earner in the family, then I have to think, and even I have to think that one, how many people are depending on my earnings and how many are there where I have dependents are there, where we have to give the treatment of medical thing and other things. So based on this, I have to decide in such a way that when what is the amount should be invested and how to invest the amount in the sector. And as I said that how many dependent members are there in my family. Like for example, if I'm the only sole earner here and my spouse, my children and my parents. So here, one spouse, 2 children and 3 parents are there. My in-law as well as my parents, so totally 3 members are there. Totally 6 members are depending on my earnings. So I have to take care in such a way that whether how to invest, what type of risk are there. If my investment increasing mode concept means there will be no problem. If it is in the decline mode, then it will be a huge problem for me. For that reason, I have to think that one and then I have to decide to invest in the sectors. Now, the basis of personal information, what life expectancy, what is the risk we have? The higher when life expectancy is longer, means they are going to say that one, if your investment wants for the long run and you have to invest for long concepts here, the risk also will be high over there. So think that one, whether you can invest the amount and you can wait for the turn. And if your earnings are invested there, whether can you take care of your family needs or not. Then you decide whether we want to invest or not there. So what is the age criteria? If your age is young age, you can think about that one. And if you are a person of age above 50 years, before investing, think twice or thrice, then you decide how much and what and where, why, and how it will benefit it. What is my employer? Whether can I depend on my earning, the source of income? If my age is 50 years and whether next how many years I'm going to work, what is the amount of benefit is going to get for me in the next couple of years. If I invest this amount, if I retire in another 8 years or 9 years, can I survive for long run or not? You think in all the angles, then you decide for the investment. That is the risk what we have. The nature of job, what type of job you're doing, whether you're working, whether you're doing business or whether you're getting the source of income through rent or any other thing. So based on that concept, you decide what is the amount should be invested, whether short term, long term, medium term, what type of risk are you ready to take that one and to face for the future aspects. The next one here, daring and adventurous people are better positioned mentally to accept the downsides of the outcome. They're saying that if I'm physically and mentally, if I'm ready to accept all the things, whatever it be, no problem, we'll take it. No problem means then if I'm in such a concept, if I'm there means even I can adjust even if there is a downfall in my investment. I believe that one. Now it is in the downfall trend. In couple of years, it may increasing mode. For that reason, I have that much of concept in the investment that I know that one now it is in the decline. Definitely it's going to increase tomorrow. So don't worry about that one. If you have a strong mind, then it's okay. If you don't have a strong mind, you never invest in the market. So next one we have here, investment objectives based on the financial information. So capital base and the regularity of income. So now, higher the capital base, better the ability to financially take the downside that comes with risk. Means how much ever you invest more money in the market, even though there is downfall also, you can manage that one. If it is your own money, if you have borrowed the funds from the market, then it is going to be very difficult for you to get back that amount or to take and face certain risk here. For that reason, the suggestion is there that one, from your savings and from your own earnings, if you're planning to invest, or else don't borrow money or don't get the fund from the outside persons or the friends or the relatives for the purpose of investment, where you may face problems in the future. Instead of taking care of yourself, if you are thinking of others, it is a wrong propaganda what you made and wrong estimation what you made, which is not better for you and your life also, because it is not your money. The money has been invested of others in your name. If anything happens, the people will blame you. If they're getting income, nobody will say anything because their amount is safe. Only when there is a downslides or if any is going to happen for my investment, then definitely they're going to blame. I don't know that one. You have to pay the full money. For that reason, before investing, take it. Don't guide any other people. If you want, you invest your money in your name. Don't give the money to other person or don't take money from other person for the investment purpose. Some of the popular risks what we have here, conservative risk, we have moderatively conservative risk, moderate investors and moderately aggressive and aggressive investors. So we have certain points here, how the risks are there and how we are going to accept that one. Investors' top priority is safety. Always I see that one. My investment should be safeguarded. It should not decline. Means if I invested 10 lakhs, the entire 10 lakhs I have to get back at the time of withdrawing the amount or when I'm taking back my invest here. So that is major thing. Moderately consider that some people are there, even a small changes in the returns, there is no problem. Okay, I've invested 10 lakhs. Even if I get 8 to 7 lakhs also, okay, I can manage that one. Some people are there, no, I want only 10 lakhs, means they're going to be conservative. If they can adjustments, they're called as moderately. Moderate investors are there where they can tolerate certain risk exchange relatively higher potential returns over the medium to long term. Means I'm investing certain amount here, I may adjust my risk according to certain position. If it is going to increase, means definitely I cannot make out. So my investment, whatever is there, I have to get back that entire amount for certain number of years. So that is a medium term. I want my returns after 20 years or 30 years, it is a long term. So some people are there, today I'm investing for the purpose of my future. So I want the full amount. I doesn't want to take care of, means I doesn't want to take any type of risk where my amount is going to be in a decline way. Instead of that one, think twice or thrice, then invest the money. Like for example, in some of the business sectors, what we have seen in our early days, where one of my friend, he invested 1 lakh in the deposits in the market deposits, what we're going to call, and later after 3 months, he was not knowing that one, and he was not aware of anything. What is market plus investment? Market plus investment. Some people suggested him, and he invested 1 lakh. Later, after 3 months, from the deposit, after 3 months, when he went and cross-checked that one, in his account, in the account of investment, where he's having 1,500 rupees instead of 1 lakh. He was got shocked that one. What is this? Where I'm standing? What was my investment amount? What is the amount I'm getting here? So he got shocked, and he said that when he had a quarrel between the person with whom and with whose guidance he has invested. Later they said, see, it is a market plus investment. Here the risk has to be borne by the investor, not the person who is advising. I have suggested you, but you have not analyzed it properly, and you have not taken the things analyzed properly, and you have not verified your account every day, or else you would have been withdrawn that amount, where in the first month the 1 lakh had reached up to 1,75,000. At that time you have not cross-checked. That was your mistake. So it is nothing but here, when we are investing, we should know market analysis strategy also, how to analyze the market, and whether my investment is safe or not, whether my investment is giving returns or not for me, even though it is my money and it was my own money from my salary. If I've invested also, right? It is the amount what we have invested, the thing pie to pie income what we have earned in our life after putting efforts here. For that reason, take care of yourself before investing in this sector. So where it can be diversified, how it can be changed to other concepts. Assess the qualitative aspects of the investment instruments before investing. Means there's a concept what we are seeing that one. First think that one. Nearly and clearly think and get yourself that one. What type of qualitative aspects are there in this particular investment? Whether my investment is safety or not, whether I'll be getting proper returns or not, whether the company is in the profit level or not, whether in the future this company's income is going to increase or not. Then you decide for the investment. Ensure to have some of your portfolio with money market instrument for the short term. What they saying that when if you're planning to invest 5 lakhs here, so do one thing. 1 lakh invest in the long term, and remaining 4 lakhs you invest in the short term. So you can safeguard your money, and which will be less risk, and even your money will be returned easily without any hurdles, and even you can have the control of your money. Ensure investment in bonds, fixed income securities. Ensure that if you're investing in a bonds, whether you're going to get fixed rate of return, like every month I'm going to get the interest or not. One needs to understand factors that impact financial markets. So you should know that what type of impact will be there in the market. If anything happens in the market, how it changes the investment strategy in the market. What are the key commodities are there in the market? And geological and political concepts are the major factors which may change the investment strategies in the market part here. One must keep themselves safe. I'm saying that you should know that when you're investing, you should monitor and analyze every day what is happening on your investment, or else you're going to lose the money. And the next one, as I said, periodic review is nothing but you have to take care of your money every 2 days or every day if it is possible. Just cross-check that whether my investment is safe, or whether there is any benefit has been received on my investment, whether the company's strategy has been changed, whether my investment amount will be increased or decreased. Analyze every day. Through an element of systematic investment plan. This would bring in the much needed discipline towards the investments. They're saying that first analyze, have a grip on the investments, so it gives you better ideas. Part of your diversified portfolio must include insurance related plans. They're saying that in this part, whatever you have 5 lakhs here, 1 lakh invest in the long term and 4 lakhs invest in the short term. In that short term, one of the investments should be insurance scheme which supports you for your future benefits, either for your future requirements, either it may be whether you can invest on your life or on the health part of your life, whatever it is that will ensure your body or all the things in the concept that where it is secured for your future benefits. What are the financial securities are there in the market? The financial securities are shares, bonds and debentures, derivatives, units of mutual funds, government securities, securities receipts, and other marketable securities. Like we have here plenty concepts are there here which supports us to know that one where how to invest. Shares we have here ordinary shares, preference shares, or equity shares. There are three different types of shares are there where I can invest the money. Only we should know that one in which type of shares if I invest that will be better. But in the present scenario, we have only equity shares, and which company shares are having the more value in the market, in that company shares you can invest. For example, Infosys company shares are good in the market, so invest on those shares if you need that one. Like this, every concept whatever we have here, these are the securities are there where you have to analyze and then you have to invest in the market. So how many different types of issues are there in the market? There are issues are initial public offering. The first offering is nothing but the shares can be issued to the public. First, they have to issue the shares to the public. The public can accept the issues. If they want, they can invest in the company's criteria, whatever they have here. When an unutilized company makes either a fresh issue or securities offer for sale of its existing securities for both first time or the public, this paves way of listing and trading of the issuers. They're saying that one, if it is the first time it is issuing, then issue to the public. If it is the unlisted and the shares which are not issued to the public, if it is remaining shares are there that can be issued to the public or to the existing shareholders after getting the concept of growth. The next one here we have follow up on public offering further issue. Whenever the company wants to issue the shares for the second time, the first preference has to be given to the existing shareholders. That is called rights issue. Rights issue means the issue should be made to the existing shareholders. If the existing shareholders declines or rejects not to subscribe the shares, then the company can decide to issue the shares to the other public here. The next one, a preferential issue is an issue. Shares are converted securities by listed companies to a selected group of persons under Section 81. If you want, you can convert those shares into the, as per the Companies Act of 1956, Modified Companies Act of 2013, and you can convert that securities into other type of shares and debentures. And so which are the factors are there which guides me to analyze the financial performance position of the company? The first ratio we have here, current ratio. Current ratio is ascertained with the help of current assets divided by current liability. Current assets is nothing but cash, bank, stock, debtors, bills receivable, short-term loans and advances. Current liabilities are creditors, bills payable, like this. These are the current asset and current liabilities. Based on this ratio, we can finalize where and how the cash is moving within the organization. Always it should be the ideal ratio is 2:1 of the company. If the current assets are 2 rupees and current liabilities are 1 rupee, then it is a better decisions are taken by the organization. Liquid ratio are those only we have to consider the liquid assets and the liquid liabilities or current liabilities. Liquid assets are those assets excluding stock and the prepaid. Excluding stock and the prepaid. Stock cannot be considered as a liquid asset, because if I want to sell any asset, so then if I approach any person, if it is around 10 lakhs, they'll ask it for 4 lakhs to 3 lakhs. Because I'm approaching the party to buy the product. When I approach the party, always the value of the stock will be very less. For that reason, stock cannot get the actual value, whatever we have recorded in our books of accounts. For that reason, we are going to exclude the stock. And the next one, debt equity ratio. What are the total long-term debts are there in the company? That should be divided with the shareholders fund. What are the benefits are going to be received by the shareholders from the organization? And the next one we have here, return on equity ratio. This is the profit after tax is divided by equity share capital. Profit after tax is nothing but after making all provisions and other things, whatever the amount is available after making the payment of taxes, that is divided by equity shares. And return on capital employed, this gives us what is the amount we have invested in the organization, what is the amount of returns we are getting. To know that one, profit before interest and tax is divided by total capital employed. Next, inventory turnover ratio. This gives us what is the control the company is having on the turnover with the concept of stock. And this cost of goods sold divided by average inventory, we are going to say that one, the answer should be informed as times. How many times we have the rollover, how many times the movement of goods is happening. And what is my earning per share? Net income after tax divided by number of common shares outstanding. Means the number of shares issued and the public whatever they have, that should be taken care. What is the net income we have here? Profit after tax, that should be divided with the number of shares in the organization. Thank you to all my dear students. In today's session, we learned about the financial ratios as well as the risk, how they're going to face by the investors for their investment in the sector. If they plan properly, there'll be no issues at all for their investments. Thank you.